Hello everyone. Welcome to Daily Wall Street. Today is March 18th, 2025, and we have a lot to cover. This week is critical for the market as we await the Federal Reserve's interest rate decision and Nvidia's highly anticipated GTC conference. Meanwhile, the OECD has lowered its global economic growth forecast, and Warren Buffett has increased his investments in Japanese stocks. What does this mean for investors? Let's dive in. Yesterday, U.S. stocks rebounded for the second consecutive day. The Dow Jones Industrial Average rose 0.9%, the S&P 500 gained 0.5%, and the Nasdaq climbed 0.6%. The Philadelphia Semiconductor Index rose 1.4%, and the Russell 2000 Index increased by 1.2%. This marks the first time since February 18th that all three major indices have posted back-to-back gains. However, the question remains, can this rebound last? The S&P 500 and Nasdaq remain in correction territory, having declined over 10% from their recent highs. This suggests that market uncertainty is still high. Key catalysts include the Federal Reserve's upcoming policy decision, Nvidia's GTC conference, and potential developments in U.S. trade policy under Trump. Investors should carefully assess their strategies. Short-term traders should avoid chasing gains, while long-term investors may consider gradual entry into the market. The Federal Reserve will announce its latest policy decision this week. The general expectation is that rates will remain unchanged, but investors are keen to see whether the Fed signals an earlier-than-expected rate cut. The central bank's stance on inflation and economic growth will be crucial. There are three potential scenarios. If the Fed takes a dovish stance, suggesting that rate cuts could happen sooner than expected, stocks could extend their rebound, particularly benefiting tech and growth stocks. If the Fed remains neutral, market volatility may increase, and defensive sectors such as utilities and healthcare could attract more interest. If the Fed adopts a hawkish tone, emphasizing inflation risks, bond yields may rise, and equities could face further pressure. Investors should prepare for different outcomes. If the Fed leans dovish, AI and semiconductor stocks may gain momentum. If the Fed stays neutral, maintaining a balanced portfolio with defensive stocks might be wise. If the Fed is hawkish, investors should watch for potential corrections in equities and opportunities in bonds. Meanwhile, the OECD has revised its global economic growth forecast downward. It now expects global GDP to grow by 3.1% in 2025, down from previous estimates, and to slow further to 3% in 2026. The primary reasons for this downgrade include uncertainties surrounding global trade policies, declining consumer demand, and the prolonged impact of high interest rates. The U.S. economy is expected to slow as trade tensions and protectionist policies weigh on corporate investment and consumer confidence. Canada's GDP forecast has been lowered to 1.6%, its weakest level since 2011. Mexico faces an even greater risk, with analysts warning of a potential recession. These downward revisions indicate a challenging macroeconomic environment, reinforcing the need for investors to focus on earnings stability and market trends. The weakening US dollar is another key trend this year. The dollar index has declined by 5% in 2025, marking its worst start since the 2008 financial crisis. Investment banks such as UBS and Morgan Stanley now forecast a weaker dollar ahead, driven by slowing US economic growth and expectations of eventual rate cuts by the Federal Reserve. A weaker dollar could have several implications. It may provide relief to emerging markets and support commodities like gold. However, it could also impact U.S. multinational companies by reducing their global competitiveness. Meanwhile, currencies such as the euro and the Japanese yen could strengthen against the dollar. In Japan, Warren Buffett's Berkshire Hathaway has increased its stake in the country's 5 major trading firms, raising its ownership from 8.5% to 9.8%. This move raises an important question. Does Buffett see Japanese equities as undervalued, or is he simply diversifying his portfolio amid uncertainty in the U.S.? Buffett's strategy reflects several key factors. First, Japanese stocks are relatively inexpensive compared to US stocks. The Nikkei 225 has a price-to-earnings ratio of about 17, lower than the S&P 500's 20 and the Nasdaq's 25. Second, Japan's economy is gradually improving as it moves away from deflation. Lastly, Buffett is known for seeking companies with strong cash flow and reliable earnings. The 5 trading firms he invested in fit this profile. For investors looking to gain exposure to Japan, ETFs such as the iShares MSCI Japan ETF could be an option. However, those interested in individual stocks should consider the impact of foreign exchange rates and Japan's evolving economic policies. To summarize, market uncertainty remains high. Short-term investors should be cautious about chasing gains, while long-term investors should consider gradually building positions. This week's Federal Reserve decision and Nvidia's GTC conference will be critical in shaping market sentiment. What are your thoughts on the market? Let us know in the comments. If you enjoyed this analysis, please like, subscribe, and turn on notifications so you never miss an update from Daily Wall Street. Thanks for watching, and we'll see you in the next episode.